Welcome to Realizing Real Estate. Each week we will be issuing a new edition, an interview with an investor, developer, business leader, government official, scholars, and others, all who in some way impact the world of real estate and the quality of your investment. Real estate has many facets. We will explore many of them in these brief podcasts. Every one of our guests will be interviewed in greater depth and length on our weekly radio show, Our House, which is broadcast every Saturday at 9 a.m. on WBN 930 a.m. and 98.5 FM HD3 in the Buffalo Niagara Marketplace, but is accessible anywhere in the world on the Odyssey app or at WBN.com. All of Realizing Real Estate podcasts are available at the iTunes Store, and our House radio shows are archived on our blog at huntrealestate.com. Join us every week and give us your feedback and suggestions for future topics, also at huntrealestate.com. Welcome to Realizing Real Estate. I'm Peter Hunt, and with me in the studio today is Karen Fuhrey, the president of Hunt Mortgage. And we're here to talk about really what's going on in the market more generally, but certainly within the mortgage market itself. But before we get into that, Karen, give us a little background on Karen Fuhrey.
Well, Peter, I've been in the mortgage industry for 47 years now. It's not what I went to school for. I went to school for interior decorating and got my first job at Buffalo Savings Bank and absolutely fell in love with it. I really like working with our first-time home buyers as they're kind of getting their first home and such. It's this exciting thing. And I still go to work every day with the same passion and excitement I had 47 years ago. So through that, I kind of worked my way up in every position there was, from processing to underwriting to management. And 25 years ago, I had the absolute best fortune ever and came into Hunt Mortgage and have been here and have done many things here, from training to compliance. And 2 years ago, I became the president of Hunt Mortgage.
Well, congratulations for that. And also there's a bunch of people that you supervise and you organize to put together any mortgage product. So how is the organization? How is it broken up? What's pieces of it?
Well, there's obviously several groups. The first group you have is your mortgage consultants. Those are our people that are there to advise our consumers on the programs and such that we have available and walk them through the mortgage process. So we have mortgage consultants available in all of our Hunt Real Estate offices. When a loan comes in, that's our operations team. We have an operations team that's made up of processors. They are in contact with the consumer to make sure we get any documentation that we need, because we're going to look at your assets, your income, your credit, and obviously the property that you're purchasing. So they handle all of that. And then it goes on to underwriting. Our underwriters can be conventional FHA, VA, or USDA underwriters, and there's various designations. You have to have so many years in the business to be a direct endorsed FHA underwriter, as well as you get your SAR notification from VA. So we have a whole group of underwriters with various designations and years of experience. And then once the loan is clear to close, it goes on to our closing team. And those closers are responsible for making sure the closing package goes out, that the consumer gets their closing disclosure in an accurate and timely manner. And then at that point, we then handle everything in-house.
The market today is vastly different than it was a few years ago. In 2021, for example, there were 6.12 million existing single-family homes, condos, detached homes otherwise, they're sold in this country. Last year, there were just a hair over 4 million. That's over one-third reduction in just a few years. The mortgage market declined even more, and particularly as it relates to refinances. Refinances are down almost 90% from the peak year of 2021. Now, obviously, that was interest rate driven. Mm-hmm. They were, in my mind, artificially low, and the Fed, people in charge then are still in charge now. Mm-hmm. What do you think really happened there? Why do you think interest rates at that time were so low? I mean, as we talked about that, we talked about it in the industry all the time, and so people jumped in. They just took advantage of what was there.
Yeah, that's really the reason that we're seeing the mortgages down now, is because I think it's like still over 60% of all Americans who have a mortgage is still less than 4%, and they don't want to give up that 4% mortgage or 3%. And I mean, my personal one is 2.5%. So no one wants to give up those rates and such. But at the time, obviously with the economy and such, the T-bill and such was kind of tanking, and that's one of the biggest things that we look at is the 10-year T-bill, and that caused the interest rates to go down because of the money was being pulled out of the bonds. And
Well, no, money was flowing into bonds. That's why the
yeah, you're right.
the yield
Excuse
was
me.
so low. Money was
That's
flowing
right.
from all over the
Right.
world. Everyone's buying our bonds.
Yes.
There, and because our interest rates generally were zero,
Right.
or right about zero, 1.25. So you were getting into something that was a hair above that,
Right.
and that was a bond.
Right.
Now, what happened was when we saw this for the first time in a long time, we saw banks investing heavily with the cash that they received from depositors, that they were investing heavily in mortgage-backed securities and also in bonds. And when all of a sudden people saw bonds going up in yield and they wanted to get their money out, all of a sudden the banks didn't have the liquidity to do that. In some cases, we saw Silicon Valley Bank, for example, decline and go under, and another couple of banks as well. And I talked recently with one of the executives of one of our local banks, and he said that the difference between that bank and a local bank here is the average depositor there was over $1 million. The average depositor here might be 10,000. So they're not going to rush to take money out for that kind of small amount of interest that they would or would not receive. But it was a real shock to the system at that point in time when interest rates spiked in March of 2022. So how's the market today? What's going on with the mortgage market today, and how do you see that reflected in the real estate market?
Well, what we see today with interest rates, we're probably, again, about in the 6.5 range. But what we have to remember is when someone says, what's my interest rate? There's many factors into an interest rate. So it isn't a one-size-fits-all. What we look at is your down payment, your credit history, your property type. All of those things are a factor into the interest rate. So we start at a base rate, and then we have these loan level price adjustments. So you and I both could apply for the same mortgage amount on the same day, but we could have different interest rates. But again, we basically start looking at the 10-year T-bill. We look at that, and generally what people want to look at is if the T-bill is at 4.3, generally you can expect that base rate to be about 2.5% higher than that. So today you'd be looking at 6.8.
You mentioned earlier about your own loan at 2.5% or thereabouts. That's created what we call the lock-in effect. You mentioned that 60% of all the outstanding loans are at 4% or less. I think it's higher than that, frankly. And if whatever it is, those people are not likely to jump into a new house just because it sounds like a good idea or feels like a good idea. They're going to be sticking around where they are. So this lack of inventory of available homes keeps pressure on pricing, number one, keeps prices up, and number two, availability in terms of just being a customer might be perfectly qualified for a loan of X number of dollars. They say, well, wait a minute here. There's nothing for me to buy at that level. So how do you react to that frustration that so many buyers and so many borrowers must feel?
Well, I look at it and say, okay, to me, it's your lifestyle. What do you want in your house? What we saw back in 2021 and in 2020, people were seeing multiple offers. They were taking at one point anything they could get because they might have made 7.
The buyers were taking.
Yes, because they could have made 7 or 8 offers on a house. So they were settling. So I have a great rate, but I'm in a house that doesn't fit my family needs anymore. So is it worth me trying to, have 5 people use 1 bathroom in a house? No. Is it time now to look for that next house? So the lock-in effect might work for some people, but I think for a lot of people it doesn't because you settled for a house. And I think we have to look at that. And, when we talk to people and the consumers, that's what we talk about. What do you want in your house? We've just came out with our renovation loan program, which I think is a great program because I bought that house and now I need to add a family room because I've had extra children or it didn't have one when I bought it, but I wanted one. You can, if you don't find a house with limited inventory, we could refinance it and get you into that house with those renovations. Or let's say you find a house in the right neighborhood, but it doesn't have a family room. Today you have that option of getting a renovation loan. So basically what you're doing is buying the house and financing in the renovations on it. So I think there's a lot of options.
You're right about the fact that people settled for something just to get a house. I mean, it was like a frenzy. People just said, well, to get me something, I want to take advantage of these low interest rates. A year later, they're looking around and maybe there's kids sharing bedrooms they didn't want to share. There's a bathroom that's getting, 5 people using it, like you're suggesting. It's just not that comfortable anymore. So there's always good reasons to buy a new house and sell the one you have, but they seem to be fewer today. And as a result, I just feel like getting another house, it's time, that kind of thing is really less of a factor. There really has to be some kind of significant movement from a family perspective or individual perspective for them to really say, I'm willing to give up that loan. But we're seeing it.
Oh, absolutely, we're seeing it. And we're seeing it for a lot of different reasons. It could be your family's expanding. You didn't buy the right house. Unfortunately, some people, due to death or divorce, have to downsize and such. So we are still seeing those. First-time home buyers are still looking for homes. They still realize that that is a great investment for them. It is still the American dream, in my opinion. So we are still seeing it. We're not seeing it at the record numbers we saw a couple years ago, but it's still an active market.
Let's look forward here in our last minute or so. Where do you see the interest rate market going, and hence the housing market?
I think you're going to look at these interest rates. I think they're going to be fairly stable for the next couple of years. I think you obviously will see some fluctuation, but I don't think we're going to see like 10% interest rates or 4% interest rates. I think that we're going to stay in that 6 to 7.5 market.
I had a conversation with someone recently. They said, well, they'll get down to 5% soon. I said, just so you know, the 10-year T-bill would have to get down to 2.5%. Yeah. And what's the likelihood of that given what's going on in the world today? I don't see that.
Yeah.
And the other factor that people don't want to talk about, or that if they do, they're not too sure what they're talking about, is the impact of our national debt. As long as our national debt is where it is, we have to fund that debt in one of a couple different ways. One is we can print money, which is highly inflationary, obviously. The other one is to raise taxes, which nobody really likes to do, but that's something that seems to be on the table from time to time. And the third way is by selling bonds. Other than that, I don't know any other way for us to fund a debt. The debt's going to be $2 trillion in fiscal 2025. That's not a small amount of money on top of $36 trillion or whatever it is today. That's a scary number for a lot of people. And because of that, like you say, I don't see interest rates being compromised to that level that where all of a sudden we're going to see 5% rates again.
I don't. No, I don't either.
Nor do I see the government allowing them to get much higher, because I think that could be a real problem for the world right now. But they can't control the bond yields. That's a matter of supply and demand. It's also a matter of who owns those bonds today and who wants to get rid of them, which is another issue that we could spend another hour on. But we do have to go. I want to thank you, Karen Fuhrey,
Thanks.
President of Hunt Mortgage, for joining me at Realizing Real Estate today.
Thank you, Peter.
I'd like to thank all our listeners. We'll be back again soon with a new episode of Realizing Real Estate, designed to help you protect and enhance your investment in real estate.